Hello, everyone. Welcome to today's virtual roundtable organized by the Digital Economy Research Network at the Center for Global Business, Monash Business School. My name is Chong Cho, and I am the director of the center. History teaches us how pandemics have spread, shaped politics, crushed revolutions, and entrenched racial and economic discrimination. They have also altered the societies they have spread through, affecting personal relationships and the work of artists and intellectuals. We know the Black Death of the 14th century was instrumental in ushering in the European Renaissance. We also know how the First Great War aided the spread of the misnamed Spanish flu, and how the pandemic in turn affected the course of the war. The COVID pandemic is still rampant, unfortunately, and we don't know what the end game looks like. While the pandemic is devastating the global economy, it is also creating opportunities for some industries. Examples are those industries based on digital computing technologies, underpinned by information and communications technologies, commonly dubbed the digital economy. One doesn't have to look far to name companies such as Amazon, Netflix, and of course Zoom, that have been booming during the pandemic. Today's roundtable brings together experts from academia, industry, and the policy circle to discuss how the digital economy is being transformed by the pandemic and how it is likely to come out of it. I'm very thankful to 4 panel members today who have generously agreed to share their time and insight with us. The roundtable will be moderated by my colleague, Dr. Arthur Campbell, who is an associate professor of economics and the coordinator of the Digital Economy Research Network. Now I hand it over to Arthur.
Thank you very much, Chung Woo. Welcome everybody to today's roundtable. We're very lucky to have with us 4 fantastic speakers, Professor Simon Wilkie, Professor Deep Kapur, Dr. Stephen King, and Dr. Fraser Thompson. The format of the webinar will be, we'll have each of our panelists speak for about 15 minutes. And then at the end of everybody's presentations, in the last 20 to 25 minutes, we'll have a Q&A session. If you'd like to ask a question in the Q&A session, there's a Q&A box down the bottom of your Zoom window, and you should be able to enter your questions into that box. They'll show up on our end, and hopefully we'll be able to get to a number of those questions in the final part of the webinar. So let me introduce you a bit more to our speakers. First speaker will be Professor Simon Wilkie. Simon is the Dean of Monash Business School. His previous roles include Chief Economist at the US Federal Communications Commission. He's also been Chief Economic Policy Strategist at Microsoft, and he's previously been a Professor of Economics at the University of Southern California. Our second speaker will be Professor Deep Kapur. Professor Kapur is the director of the Monash Center for Financial Studies. Previously, he's been the managing director at Salomon Smith Barney, Citigroup Global Markets, Daiwa Capital Markets, and the event-driven hedge fund Symphony Financial Partners. Our third speaker will be Dr. Fraser Thompson. He's the co-founder and director of AlphaBeta, a strategy and economics consultancy. Prior to this, he worked at McKinsey & Company, where he was a senior fellow at the McKinsey Global Institute. Our final speaker will be Dr. Stephen King. Dr. Stephen King is a commissioner at the Productivity Commission of Australia. He's previously been a commissioner at the ACCC and the Dean of the Faculty of Business and Economics at Monash University, and of course a Professor of Economics at the University of Melbourne and Monash. We'll start today with Professor Simon Wilkie. Welcome, Simon. Thank you so much for joining us today.
Thanks, Arthur, for inviting me to this august panel. Happy to be part of it. I have a deck. I might just go through a couple of the slides in the deck quickly, just to explain the perspective that I'm bringing. As Arthur mentioned, in my previous life, I've been in the role of a chief economist. So let's get started with the obligatory economics joke. So this is an old Dilbert one. Our CEO wants to promote you to chief economist because nothing you say makes sense. He thinks that's the sign of a great economist. So the answer is it totally is. So say something smart, whoa, I don't want to create an oversupply of wisdom here. We're in danger of having a chronic oversupply of wisdom in this virtual room here today, I'm afraid. So I want to frame today's topic in terms of Industry 4.0 or the fourth industrial revolution and how COVID is accelerating that revolution. Let me just start by putting some meat on the bones. Everybody talks about it, but doesn't say what it is. So what actually is the fourth industrial revolution and why is it going on now? It's about industry, corporations, government, changing the way that they operate to being data-driven rather than human-driven. What does that mean and why is that going on now? Well, it's due to a few things that have come together. The first thing is the creation of cheap sensors generating amazing amounts of data, 25 zettabytes of data as due to be generated this year. That's more than in the history of humankind. So we have cheap sensors that have become ubiquitous. Everybody's got 2 camera sensors on their phone. In this virtual room, there are hundreds and hundreds of sensors connected right at this point in time, generating data. And currently via Zoom, we are able to do this because of ubiquitous and cheap connectivity. This is a revolution that happened starting in the 1980s, but really took off in the 1990s with the development of optical fiber to backhaul data at unimaginable capacity and really, really low rates, combined with the wireless revolution, which happened in the 1990s when government realized that, hey, if we auction this thing called spectrum, we get to raise hundreds of billions of dollars for free without raising taxes. And so the amount of spectrum that went to communications just has exploded since the US spectrum auction started in 1994. I will point out that the first country to do spectrum auctions was actually New Zealand, but they actually messed it up. So it's an interesting case study. And then in the early 1990s, we started to have dramatic rises in machine intelligence. So we were able to exploit that data that was being generated and then backhauled cheaply with a lot of power. But frankly, that sat on the shelf and didn't do much until a few years ago, with really the rise of cloud computing. Cloud computing enables us to access all of this data and store it cheaply and just throw massive amounts of computational power at a problem in ways that were unimaginable before. It also fundamentally changes the nature of industry. Unless you're one of the cloud computing providers, you no longer have to invest in a heavy IT infrastructure and in a heavy IT skill set on your staff force. You can run your company virtually on the cloud. So for example, Netflix runs on Amazon, as does Airbnb, as does Uber, other companies. If you use Dropbox, that runs on Microsoft's Azure platform. They gave up having their own storage facilities. What really took off was after the Snowden revelations of spying. It created a shock to the reliability or the reputation of cloud computing, which ties into the privacy issue. And then that sort of shock to the demand for cloud computing triggered a price war. Google started the price war in May 2014. The price of cloud computing fell 65% in 1 week. So, whereas the price of connectivity had fallen 95% for long backhaul connectivity, that started in 1999, fell 95% between about 1999 and 2003. But the price of cloud computing fell 65% in 1 week. So what happened since about 2014 is we have massive amounts of data, unbelievably high pass-through capacity, incredible machine intelligence, computational ability, and now the ability to crunch that data cheap and elastically without sunk cost investments. So this is revolutionizing the way that firms are doing business. We've seen a revolution once before like this. It was in the 1900 to 1920 period, where the world changed and the way that businesses operated in a relatively short time span. So in that period of time, we got the automobile, the aeroplane, telephone, radio, electric lights, the phonograph, and most importantly, indoor plumbing became mass available. So this is a picture of New York City. The building in the middle there is the Flatiron Building, one shaped like a triangle. It's the first steel skeleton skyscraper ever built. This is the same shot. That's the shot in 1900. This is the same shot in 1920. So you can see all of a sudden the streets are filled with electric lights, cars, electric trams. It's a different universe. So we're going through that now. Here's just some of the things that are going on in terms of the technological acceleration, changing the way business operates. Some of you might be enrolled in a course next semester here at Monash, where people are asked to identify one of these and write a business model around it. But the impact of all of these changes are scaring business witless. So this is a few years ago, Harvard Business School survey of 436 CEOs. Only 23% of them were confident that their organization had the knowledge and skills to succeed in this digital transition. That was pre-COVID. That was in good times. So imagine how confident they are today. What does all this mean? This new transformation of the technology means new types of markets are going to arise. Uber is just the beginning. Uber is a case of a market replacing a non-market mechanism. It's not just replacing taxis, it's replacing yourself as the vertically integrated firm who drives yourself around. New types of organizations are arising. GitHub is a new form of how teams form and solve problems that's outside of the usual form of employment organization or a firm. We're seeing new types of contracting being adopted, both in industry and elsewhere, which changes the nature of work and the nature of what it means to be a firm. You can go back to the old question asked by Ronald Coase: why do firms exist and what's the limit of the firm? This is all being challenged by the availability of these new technologies. And of course, new jobs are going to be created and old jobs are going to be changed. I want to just quickly whip through the deck. We don't have time to go through the whole thing, to this one slide. This is a slide based on US data. I think it's particularly pertinent to Australia because Australia missed the last few recessions. And what we're seeing in the job market is a fundamental change in the nature of recessions that started in the 1990 recession. Up until then, in a recession, jobs were destroyed. In a recovery after the recession, jobs came back, and they were the same jobs. What we started to see in the 1990 recession, which was very mild, so economists didn't even notice this till years later, was routine jobs where people were doing the same set of tasks every day were destroyed, and a bunch of them never ever came back. They were replaced with technology. This was with the third industrial revolution. What happened after the dot-com bust in 2000 was this whole thing accelerated tremendously. 2.4% of jobs were destroyed, and again, they never came back. When we had the global financial crisis, another 4.5% of jobs were destroyed, and they never came back. So what we're seeing in this recession is this is a much more dramatic recession than any of those previous ones. The economist Nick Bloom at Stanford and others estimate that about 40% of the jobs currently lost in this downturn are not coming back. So what's happened due to COVID and the transformation that's forcing companies to adopt this new technology, forcing us to move into the digital realm, is basically 3 years of transformation have happened in 3 months. And this whole thing's going to be accelerated much faster than I was originally predicting. And the key to success for both individuals and companies going forward is not to be scared, but to think of it through the lens of complements and substitutes, right? So with the rise of this technology, the question is, what do I do as a human that is complementary rather than a substitute for the rise in artificial intelligence and data-driven decision-making, okay? And we can see that this is what happened the past time around with mechanical labor, with the second industrial revolution between 1900 and 1920, was we had the first industrial revolution, which led to a period of de-skilling. It led to mechanical devices replacing human labor, rapid rises in inequality, rapid rises in de-skilling. And then we had the second industrial revolution, as we learned how to develop human skills that were complements to the technology rather than substitutes. And we had the rapid rise in the middle class, the rapid growth in incomes, the rapid reduction in inequality that lasted through to about the mid-1980s. So now we're going through another substitute phase. And so the question is, going forward, as we get out of this COVID situation, what are the complementary skill sets, and how is that complementary skill set going to add value going forward? So another way to look at it is, this is the composition of jobs in the 20th century. At the start of the 20th century, 50% of people worked in fairly menial jobs. A large number of them were actually servants, farmers or farm laborers. That went from 50% of employment to about 5% of employment by the end of the 20th century. And the new jobs that were created were basically the rise in what we consider middle-class jobs now: professional, technical jobs, clerical, managerial jobs, and service roles exploded. What we're seeing now is a similar transformation. If we look at this century, here's where jobs have been lost: production, office and administration, middle management, construction and extraction. And here's, these are US numbers again. And when we look at where jobs are being added, we see this bifurcation. That is, we see a huge number of jobs being generated in the service area, where human skills are particularly important, but the jobs tend to be low paying. So you notice the fastest growing sector of the economy in terms of employment was personal care. That is, your yoga instructor and your dog walker are really, those jobs are really growing like crazy, not particularly high paid jobs. But the second fastest area is in finance, and these are high paying jobs. So this dramatic transformation that's going on in the economy is going to have a huge impact in Australia. It's going to create new firms, new ways of doing business, and it's going to change the nature of employment in ways that we haven't anticipated at all. So we need to be flexible and agile going forward. So I'll just whip through the rest of the deck and say thanks for your time, and I look forward to the questions.
Thank you, Simon. Our second speaker today will be Professor Deep Kapur. He'll take it away now. Thank you.
Thank you, Simon, for setting a bit of a backdrop for what I want to talk about. That's very helpful. I want to focus on, given my background and what I do on a day-to-day basis at Monash, I want to focus on COVID-19 and how investing in the digital economy has or has not changed. It's quite a lot of material to go through, so I might go a little fast, but you can ask me questions at the end. And what I plan to do is to first start with a few observations on the macro. I mean, the digital economy doesn't live in isolation, and make some observations on the macro environment that is facing investors who are interested in the digital economy. I'm always asked questions about the valuation of companies in the tech economy, so I will spend a couple of minutes on that question. And then finally, give you a bit of color on where investors are placing their bets today after COVID, you know, what people think are attractive, and also give you a sense about how difficult it is to actually invest in this space. If you don't know what you're doing, then the results might not be as impressive as you might want it to be. So to start with the macro, one thing that we know for sure is that we are going to be in a more indebted world. The global debt to GDP ratio has been climbing since 2007. It's 210% to 242% in 2019, and it's on trend to expand because of what has transpired. So from an investor's standpoint, they like the tech companies in the digital business, especially the large ones, the asset-light ones, because their balance sheet is very strong, and that's a great competitive advantage, at least in terms of shareholder perception. We've had massive monetary and fiscal stimulus. This has prevented a financial crisis and depression, but you know, judging by what has transpired in Japan over the last 20 years, this has also created an environment where many zombie companies will be kept alive for longer than they otherwise would be, and that does. It's not a headwind for the tech economy, but it is something to be mindful of. I honestly don't know where the economy is going, and you know, every day there are 20 emails in your inbox with various alphabets about how the economy will recover, whether it's square root or not. But I think it is fair to say that we'll have a weak economy for some years with or without a medical solution. For non-tech businesses that have not digitized fast enough in the last few years, it will become an existential problem. So it's a matter of survival. I think this will be particularly great for software companies. Already software investment is 3% of GDP in the US, and most venture investors and others looking at this space seem to think that that will continue to expand in the years ahead. The other thing that people are thinking about is, you know, what new frontiers big tech is going to colonize. Are they going to, you know, help a manufacturing business with better enterprise software and so on, or are they going to enter other areas like education, which is our business, and healthcare as well? They have been dabbling in some fashion or the other with banking and finance, as we know, and that activity will also continue to grow. For the digital economy, geopolitics is important for a number of reasons. It seems quite likely that given the experience of the pandemic, the tech hardware supply chain will likely go through some changes. I was looking at some research from Morgan Stanley, which estimated that 64% of global tech hardware components are currently made in China, and 80% of assembly is carried on in China. Given the state of geopolitics and an increased focus on resilience versus cost and efficiency, it is quite likely that there will be some shifts in the supply chain. And that's something important to stay on top of and watch how it evolves. The other issue related to China, as far as the digital economy is concerned, is we may end up with a bipolar digital world, with China in one camp and the US and allies in another camp. Meanwhile, China is on path to transition from a fixed asset driven economic model to a more tech driven economic model. And you know, that's a transformation, if successful, will take many years. But there is a lot that is happening in the digital economy in China, and many non-Chinese enterprises are interested in that market, will continue to be interested in that market given the speed of progress. And however, it remains to be seen how that'll play out. And it applies to the Chinese companies interested in the US and European markets. You know, I have a sense that one of the reasons Tencent bought a material stake in Afterpay is because it gives them access to the US consumers in a way that they may not be able to access going forward directly on their own. Antitrust issues in the US is often talked about as a challenge. It has something to do with COVID in a political sense. Although some VCs like the people at Union Square Ventures believe rather than forcing entities to break up, the most likely scenario is some pressure on them to share data and so forth. There are tax issues in Europe, as we know. I think it is safe to assume that there will be some regulatory impact on the digital economy, but it is not going to be perhaps as onerous as the banking and finance sector faced after the 2008 crisis, so that's not going to derail the fairly rosy picture that I have been painting. Mergers and acquisitions activity this year is important for the digital economy because it has a bearing on the funding of early stage enterprises. Global M&A fell about 25% in the first quarter. And from the data that I've been able to get over the last few weeks or so, it looks like it is struggling to recover in the second quarter. Now, I had thought that this might be partly because of the difficulty of doing due diligence over video. But Goldman Sachs Investment Banking is apparently doing more M&A related due diligence meetings using Microsoft Teams and aerial drones to have a look at the manufacturing facilities than they were in the past. It's just that deals are just not getting done. People are not pulling triggers for two reasons. One is the economic uncertainty is quite a drawback to making decisions. And there was that short period of time when valuations were ratcheting down really fast when there was an opportunity to acquire high quality assets at reasonable prices. But now we have a situation where money is free and sellers are not willing to part with businesses as fast as the buyers would like to own them. But there is really no reason to believe that once the situation with COVID settles down a bit, that M&A activity will not return to its levels prior to COVID, because there is no shortage of money whatsoever. I mean, private equity has about $3 trillion of undeployed capital at this point in time, which needs to find a home. One of the questions that people ask quite often is, it's all very well, the digital economy has done much better than the non-digital economy, and therefore, valuations are very high, and are we about to see a crash? Is it a bubble? I don't know if it is a bubble or not. It's kind of hard to, figure out whether something is a bubble or not until it has actually popped. But in absolute terms, yes, companies associated with the digital economy and generating, strong free cash flow are, in absolute terms, expensive. The NASDAQ trades on a PE of 35. The S&P technology trades on a PE of 25. Non-US tech companies also trade at lofty multiples. But relative to history, if you're watching for bubbles, NASDAQ PE peaked at 70 times in '99. So, those companies did not have as strong fundamentals as the current crop has. So it may not really be bubble. Plus, the earnings numbers for big tech just came in. And in the first half of 2020, the big 5 tech companies in the world have grown their earnings between 6 to 34% in the first half of this year, despite the pandemic and so forth, relative to the corresponding period in 2019. So the quality of these businesses are quite solid, and institutional investors are not backing away from financing the digital economy, which I think is a good sign. And as the chief investment officer of a large pension fund pointed out to me the other day, he said, look, I have a choice between owning a basket of key players in the digital economy and paying 25 times next year's earnings. If I don't want to do that, I want something safe. What can I buy? Do I buy a 10-year US Treasury bond at 200 times next year's interest? So, that's the world in which we live in, which is not great from a value investor standpoint, but it is what it is. Let me now move on quickly to, I've got a couple of minutes by my clock. Where are investors placing their digital economy bets? I would say at this point in time, anything associated with deep learning is where most of the money is going. And that's going into anybody who's making software that is writing software. The hardware that is needed, accelerator chips is expected to be an $18 billion business in 2024. There's a lot of excitement about AI expanding from vision to language. The second important area where capital is available readily is anything to do with streaming media, particularly cloud gaming. Electric vehicles post-COVID seem to have become quite popular as an area to do due diligence on. Not just buying, stock in Tesla, but people are even wondering about the traditional car makers because, we're now EV vehicles are nearing price parity with petrol-powered cars. So that's an area. Automation, again, COVID has been somewhat positive, and robots, automation systems, prices are coming down. Amazon last year had 200,000 robots in its fulfillment centers, and that's growing. 3D printing, COVID positive again, but that's an area where some people think it's at a tipping point, some people think it's niche. Credit Suisse thinks that sales of 3D printers in 5 years would be 12 billion, and ARC Investment, which has more skin in the game because they're an investor, think it will be 100 billion. And that's an area that's of interest. Car ownership in general seems to be a COVID positive situation for obvious reasons. And even though deployment has been delayed for autonomous riding, both Waymo and Cruise are behind, the market seems to be getting behind the possibility that tech platforms who would provide the software for this in connection with the developments in 5G, this is probably an area which will soak up a fair amount of capital. And I could go on. Aerial drones is a hot area right now. Next generation DNA sequencing. Related to that, biotech R&D efficiency is an area absorbing capital. Price of gene sequencing seems to be collapsing by the month. And biotech and pharma companies, given access to all of these data, are now beginning to hire data scientists and machine learning specialists in particular at roughly the same sort of rate as the conventional tech companies. Fintech is sort of doing okay, particularly anything to do with digital wallets is doing fine. Wealth tech is not doing so well because the value proposition seems to have gotten confused. And there's continued institutional interest in Bitcoin and crypto, although nobody seems to be quite sure how to make money in that area aside from speculation. So with that, let me summarize in a nutshell that, as Simon alluded, COVID-19 has accelerated a number of structural trends in the digital economy, which is very beneficial for investors in that space. And I would be happy to take questions at the end. Thank you. Over to you, Arthur.
Our third speaker today is Dr. Fraser Thompson. I'll let you take it away, Fraser.
Terrific. Thank you, Arthur. And hi, everyone. Pleasure to be presenting today. I really want to talk about just three things. The first is talk a bit about what is the broader digital opportunity for Australia, and why haven't we seen the bigger uplift that we've been hoping for. The second is then to talk about what's shifted from COVID, and we've heard a few different things. I want to talk about 5 things that I think are particularly interesting to know. And then finally, I just want to finish with a few of the implications that I think matter from a business perspective, but also governments. So diving into it, we've heard about different technologies. There's lots of different lists. When we think about technologies at AlphaBeta, we group them into these 8 buckets, from digitizing distribution channels, mobile money wallets, advanced robotics, additive manufacturing, IoT, AI, big data, and cloud. And when you look at the applications of these technologies, what's interesting is that they span a range of different sectors. So this page just gives you a sense of some of these applications of relevance of sectors. So in agriculture and food, we see this adoption of precision farming with the potential to double yields. In health, we see the range of different technologies from detection of counterfeit drugs through to electronic records. Education and training, we see obviously things that are incredibly important today around personalised learning and online retraining programs. So across every sector, there's a range of really significant implications and technological applications that could significantly improve productivity. A piece of work that we did together with Google looked at what could this mean for the Australian economy. And so what we did is we took those applications that I just showed you before, and then we said, what would be the potential for Australia in 2030 if we were to fully exploit those digital applications? And as you can see from this slide, the potential is big. It's close to 200 billion additional economic impact in Australia by 2030. So it's something really significant. What's interesting here, though, is where that opportunity is. We often think of this digital technology as home to a few specific sectors of ICT, financial services, etc. But some of the biggest beneficiaries are the more traditional sectors. So the resources sector here in Australia is actually the biggest opportunity that we identified, $65 billion of uplift from a business as usual approach through these adoption of technologies, but also a range of applications in healthcare, infrastructure, education and training. So it's important to understand that this digital revolution we're talking about is not narrowly defined in terms of a few sectors. It actually has the biggest potential in the more traditional sectors of the economy. Now, this kind of raises the question of, well, why haven't we seen more uplift already? The economist Robert Gordon has talked about the fact that we're in this sort of structural stagnation in terms of low productivity growth. And Solow back in the 1980s talked about the Solow paradox of saying we see computers everywhere, but not in the productivity statistics. And so some have questioned, is this digital potential we're talking about, is it actually all that significant? And if so, why haven't we seen a bigger shift in productivity growth rates? Now, there's lots of different reasons for this and different possible drivers. Some people have talked about measurement errors. So there's a lot of these new digital technologies we don't really well capture in GDP figures. So think about using geospatial technologies such as Google Maps. A lot of the value that we get as consumers for that is not directly attributed to any form of GDP. So there is probably a measurement error. But what I believe is actually a bigger issue is around the lags in adoption that come with these digital technologies. And it's worth pointing out that the Solow paradox actually was ended eventually. And it was ended about 5-10 years later after Solow made those first remarks. And one of the biggest drivers of this was when you saw mainstream companies like Walmart really start to incorporate computers into their operations, and it spread to SMEs. And I believe the same thing is going to be happening here. So the size and potential is significant. There is this important lags that go with this. And what's interesting, if you look at this by sector, there is a very different performance in terms of sector adoption of these technologies. So on the y-axis here, I've got the potential economic impact of these technologies by 2030 by sector. And then on the x-axis just has the degree of current adoption today. And this is what we see across a range of different countries. But you see in terms of the digital leaders, we've got the financial services sector, we have aspects of the resources sector that have picked up this, but then you see a long laggard of sectors that are doing very little. So from government to agriculture and food to infrastructure, where even though there's some applications that have been discussed, the mainstream adoption of that today is still very limited. So I do think there's a real agenda item, particularly from an Australian context, of how do we think about mainstreaming the adoption of these technologies. And I believe if we do that, we'll start to see the transformation of productivity growth rates. So that's kind of a backdrop of the broader landscape of digital technologies. When it comes to COVID, there's lots of things we could talk about here. I want to talk about 5 shifts that we're seeing that we think are important in COVID when it relates to digital technologies. The first one is around data-enabled healthcare, and that includes remote patient monitoring as well as telehealth. So the opportunities here are big, estimated at over $120 billion in Asia alone by 2030, but adoption is pretty mixed. If you look at remote patient monitoring, it can reduce the costs of inpatient care by around 30%. And that's a huge saving, not only just because of COVID, but also as we have an aging population where there'll be greater demand for healthcare space. Similarly with telehealth, huge challenges, particularly if we look at the broader Asian region, about access to doctors. So where I am here in Southeast Asia, we only have 0.6 doctors or physicians per 100,000 people. And that's only about 13% of the levels that WHO recommend. So telehealth can help, if you like, substitute that skills gap that we see. The second one is around accelerated automation of manual tasks. And it's great that Simon has already spoken about that. And I'll add on a few points there. Rethinking supply chains is also going to be a big area. E-commerce, and I'll talk a bit about that later, but a major opportunity. And Simon mentioned how we've seen basically 3 to 4 years gain in 3 months of e-commerce. And I think that's important in the Australia context. where Australia's been a bit of a laggard in e-commerce. So only about 10% of sales are online, which is far less than we see in other countries in Asia, where we're seeing north of 20% penetration rates. And I think e-commerce will obviously see a big transformation from COVID, and we're seeing 300 to 400% growth rates in certain categories. But I do think it's important to stress that it's a very uneven growth. So we're seeing downsizing by consumers away from the luxury items to the more discretionary items. And so very different category growth within that e-commerce. The last one around digital immersion, we're obviously familiar with Zoom and Zoom's stock prices skyrocketing as we speak. But I don't think it'll end there. I think this is actually just the start. I think this will actually pave the way for new technologies, and we'll start thinking about virtual reality and augmented reality in a much more serious and mainstream way than we have in the past. So those are trends I want to briefly speak about, and I won't go through all of them just in the interest of time. When it comes to healthcare, telehealth, a range of interesting opportunities here, from upskilling workers through to e-doctors to platform services to rethinking consumer power. And this is one of the most exciting areas that we're seeing here, particularly in Southeast Asia. China has really been leading many of these areas in this kind of healthcare revolution, just benefiting from that huge scale. But increasingly, we're seeing other Asian economies really start to adopt these services, basically out of pure necessity, given the gaps in terms of adequate healthcare provision. When it comes to automation, we could spend a lot of time on this, and Simon's already made a number of really good points about this. I think one point is worth mentioning is that actually the rate of automation is not higher than what we've seen previously. So if you look here, this is the job losses that we've seen by sector over time. And you see actually the total rates are quite comparable to what we've seen in the past. The thing that's really shifted is where that automation is coming from. So traditionally it used to be in the agricultural and then in the manufacturing sectors. Now it's increasingly moving into the services sectors. So if you like, it's the breadth of automation that's really shifting here rather than the scale of that. But there are two important caveats I'd put onto that. The caveat number one is that we do see after a big financial hit that there is this increase in automation. And we saw that with the financial crisis. We're seeing it now, and the Bloom research that Simon talked about, I think is probably very accurate of what we're going to see. The second thing is that Australia is actually a bit of a laggard when it comes to automation. So if you look at this OECD data, only about 9% of publicly listed firms in Australia are engaging in automation activities. Compare that to, say, the US or Switzerland, where it's over double those rates. So Australia is a relative latecomer when it comes to automation. And I think we're going to start to see more of a shift, probably prompted faster because of the COVID response. And that'll create a whole set of new challenges that Australia will have to deal with. And in terms of what this means for job tasks, AlphaBeta did a series of research for Australia to look at the different types of worker tasks that are going to be occurring. And what's interesting is that you see obviously this shift away from routine work to non-routine tasks, whether those be non-routine analytical or non-routine physical. What I find interesting too is that that's pretty consistent with what we see in other economies, but increasingly the new technologies that have been developed are also starting to automate non-routine physical. So robots are getting more dexterous, working more confined spaces. And so we may start to see that happen much more quickly than we thought. And increasingly with things like Industry 4.0 and the development of AI, we're starting to see that non-structured learning increase as well. So I expect actually a broader shift in this task base than we're probably expected today. And I don't think that's all negative. I don't believe we're going to see mass unemployment. I do believe there is going to have to be an incredible skill revolution at a much faster pace than we're seeing at the moment. And AlphaBeta has some research coming out shortly, which looks at exactly how much of a reskilling revolution we're talking about in the Australian context. On supply chains, a number of really interesting things happening here, from food security concerns, we're seeing geopolitics and so forth that are really starting to have an impact. Some of the exciting things that we're seeing is particularly around new firms that have been developed to try to take advantage of data enabled by digital technologies. So CombiWorks is matching supply and demand and manufacturing capacity. Cargomatic connecting shippers with local truckers. So a range of these technologies are really trying to transform the efficiency of these supply chains. And obviously that's crucial in the Australian context, not only domestically, but also as we think about export to our nearby markets. So I'll stop there, but just wanted to end and talk about what I think are some of the implications, and would love to have a broader discussion about that in the panel. From a business standpoint, there's three things that I want to highlight. The first is around how do you maintain digital budgets during this cost pressure that we're in now? We're seeing, particularly in Southeast Asia, a number of companies that are slashing budgets quite significantly, and that's included across the board. Slashing the digital budgets right now seems to be an incredibly short-term reaction for where there's a critical long-term need. So the ability of companies to see through this and take those long-term investment decisions on digital is going to be important. And most companies today, when they say they do digital, when we look closer, they're really just doing digital on the exterior of their operations. Their core decision-making is largely unchanged as it was in the pre-digital era. The second is around understanding which consumer behaviours are going to stick post-COVID. You know, what was interesting after the Spanish flu epidemic in the 1917 was that we saw a long-term shift in consumer trust. And that led to a completely different behaviour in a range of different sectors. So what is going to be the equivalent of what we see here? Will we actually see the bounce back to retail or more personalised physical services? Or will we start to see much more remote interactions? And to my earlier point about virtual reality and augmented reality, will we see consumers actually staying at home more and thinking about virtual reality as their kind of escapism, if you like? It may seem crazy, but these things can change very quickly. The third thing for businesses is around this rethinking the social contract. I mentioned that automation rates have been low in Australia compared to other countries. That I think is going to accelerate. And with that is going to come greater pressures on companies to show that they're stepping up to the plate to really be supportive of that skills revolution that we're having. Unfortunately, what we see today is that too many businesses are not meeting those obligations. Many of them are actually just recruiting new labour with those skills rather than retraining their existing workforce, for example. And I think there'll be greater pressures on businesses to really step up on this agenda. When it comes to governments, there's a range of things we could talk about. The two things I just want to focus on is this reskilling revolution. I think the analysis we're doing at the moment shows Australia's doing pretty well in certain areas. The challenge is that we're not doing it at the volume we need. And we don't have exactly all the digital skills covered that we're seeing that are emerging. So issues like cloud technology and also that digital privacy, these are areas that are moving very rapidly, where we see significant gaps in curriculums and the evolution today. And also with this is going to come new forms of support. What's interesting in the COVID-19 response, we saw a number of categories of workers that were missed out, not least of which is freelance workers, which are a greater share of the economy today. So I think there's going to have to be a real rethinking about how governments think about engaging and reaching all types of workers rather than just traditional workers. So I'll stop there, but I'm looking forward to hearing the other speakers and the questions that will follow. Thank you.
Our final speaker today will be Dr. Stephen King. Take us away, Stephen.
Okay, thanks, Arthur. What I want to do is take a slightly different approach to the other speakers, because it is undeniable that there's been lots of technological change going on. There's been lots of technological change before the current global pandemic, and there will be afterwards. And in a sense, I want to look at that question that Fraser raised, which is, where has the pandemic led to a permanent change from trend for that technological change? So I'm going to do this in three parts. First, where and why will the pandemic lead to long-term change in the take-up of digital technology? Secondly, where does increased adoption of digital technology create issues for government? And finally, I want to look briefly at the issue of data rights in the pandemic. So firstly, will COVID-19 lead to long-term changes in the take-up of digital technology? Well, the simple answer is yes. The more complex answer is going to depend? So let's start off with the simple answer, yes. We've seen a rapid expansion in the use of digital products and services during the pandemic, and that's been in areas of shopping, education, healthcare, entertainment, for example. So during the pandemic, Australia Post estimates that online spending levels in 2020 are going to reach the levels that they originally predicted for 2025. If we look at an average week in 2019, an average of 1.6 million households bought something online. In April this year, that had gone up to 2.5 million households per week. So we've seen change due to the pandemic, but is that temporary or permanent? So as a matter of economics, the fact that there's been this at least temporary change is not surprising. The pandemic has raised the costs of physical substitutes, either through government regulation or more importantly, through the health risk associated with physical interaction. So people have reacted to the cost change by substituting to digital products. This change in costs will hopefully be temporary. So the real question is, why won't we see the old physical interactions returning to dominate when the current cost shock disappears? Now, again, the economics is pretty straightforward. For a change to be permanent, the pandemic must have led people and business to invest in fixed and sunk costs that will change the marginal choices post-pandemic. So, what are these sort of investments? Well, for business, these investments include trialling and implementing new front and back office technologies to better enable non-physical transactions. Now, for example, supermarkets investing to support greater levels of online orders, manufacturers developing black facilities and contactless supply chains, educational institutions investing in online and reusable video classes. For consumers, these investments include personal investments in mastering digital technologies, including online shopping, digital payment technologies, and video-based health services. The key issues are these investments sunk? Will the marginal benefits of using digital technologies outweigh the marginal benefits of traditional physical technologies so that consumers and businesses find it optimal to continue using the digital technologies post-pandemic? How will businesses that have large sunk investments in physical technologies respond to digital competitors? And how will governments respond in terms of regulations? So let's look at each of those four issues. For sunk investments, let's consider education. So there's been huge changes in education due to the pandemic. Schools and universities in Australia and across the globe have shifted to e-learning through videos, chat and Zoom. At the end of March, globally, over 1.3 billion children and 60 million teachers were no longer in the classroom. But from the production side, much of this has involved little sunk investment. Teachers are still continuing to teach in just the same way as before the pandemic. They're just using video to replace face-to-face interaction. These videos appear to be disposable. They're not designed to move the class online in the future. On the demand side, school students appear to miss the physical interaction with friends that school brings. So my prediction is that there will not be any schooling revolution post-pandemic. There may be sectors that are affected, such as international students and parts of higher education. But it is far from clear whether digital transformations that have occurred during the pandemic will actually last and will speed up after the pandemic. What about the marginal benefits? Let's think of working from home. That's been an area we've seen a revolution due to the pandemic. It's involved some sunk costs, particularly workers learning how to use new technologies, ways to manage teams and interact online. But the marginal trade-offs in this area are well known and have been well known for years. Home-based work can increase worker autonomy and reduce costly commuting. But it comes at a cost to the worker in terms of isolation, loss of interaction, loss of serendipitous conversations, and a lower or reduction in promotion prospects compared to those who are seen in the office by managers. So for business and managers, while moving online, working from home can reduce office costs and space costs, it leads to a loss of control. Now, none of this is new. The sunk costs haven't changed this marginal calculus. So again, I expect homework to pretty quickly reduce back towards post-pandemic levels, at least once you don't have to commute on trains of death. There may be some increase in home working, but this will be for a maximum of a few days a week. Both employees and employers will want to have workers in the office. That's too important at the margin for home-based work to revolutionise most businesses. So what about physical businesses? They're not going to just sit there and let this digital revolution happen. They're going to fight back. Let's consider retail. The movement to online shopping has been sped up in Australia due to the pandemic. But again, we were behind, for example, the US leading into the pandemic. And the US can really provide a mirror to us about what will occur in Australia post-pandemic. Now, in the US, pre-pandemic, two things occurred. Either existing shopping malls had transformed their activities to become physical entertainment hubs, including retail, but also restaurants, bars, sporting activities, cinemas, and so on, or they'd shut their doors and the land had started moving back to more valuable uses. This was occurring in Australia before the pandemic, albeit at a pretty leisurely pace. I expect this to speed up post-COVID. And similarly, in other areas, we'll see traditional bricks and mortar institutions adapting to concentrate on their valuable physical interactions. And if they don't do that, they'll die out. One prediction is for universities going forward. Once the world's top schools enable exclusive online study, less prestigious universities in countries like Australia are only going to survive if they make the on-campus experience highly desirable. Now, unfortunately, pre-pandemic, most Australian universities weren't thinking that way. Finally, what about the government response? Let's look at newspapers. With the considerable assistance of the ACCC, traditional newspapers in Australia have successfully lobbied for government intervention to improve their bargaining power against so-called news aggregators, such as Google and Facebook. Despite the fact that these aggregators operate within copyright law, and that newspapers gain a significant amount of traffic to their websites and the associated advertising revenue from news aggregators, it is apparently in the public interest for government to establish a mandatory code of conduct to skew bargaining power in favour of these traditional media companies. Now, this example may be at the extreme end of the spectrum, but expect many similar cases post-pandemic. Many businesses that will face enhanced digital competition are going to seek government protection using supposed public good arguments for their continued operation. So, I'm a bit of a damp squib so far. The pandemic will lead to fundamental long-term change in the take-up of digital technology in some areas, but the simple economics and the potential for successful rent seeking means that I don't think this is as broad as many people seem to think. Okay, second bit, where does this create issues for the government? There's a range of areas. Fraser's already talked about health, so I'm going to very briefly mention that. In health, the pandemic has obviously been a disaster, but the technology in health has been an overall positive story. For example, video consulting in psychology and psychiatry, that along the lines of what Fraser mentioned. Whether or not, though, these services will continue post-pandemic will depend on government policy. Pre-pandemic rules place strict limits on video consulting by psychologists, psychiatrists, GPs, and so on. These rules were relaxed or have been relaxed during the pandemic, but they're not guaranteed to continue. Now, for example, with video therapy, there is very good evidence that it increases access, and it is as good as face-to-face therapy for many, many consumers. So there's a strong argument for continuing the subsidisation of video consultations through Medicare post-pandemic. But the government has to make up its mind on that area. And it's not clear. There's been claims already of rooms full of GPs providing minimal service using video apps and simply bulk billing and trying to maximise returns from the Medicare system. If we're going to move to a more general world post-pandemic with things like technology and video consulting, distance services and so on, we're going to have to make sure that the government thinks about how to incorporate them in the MBS system. What's another area the government's going to have to look at? Well, payments. The pandemic has sped up the death of cash. Digital and contactless payments have rapidly increased during the pandemic. Westpac estimates that approximately 50% decrease in ATM withdrawals in April compared to February this year. MasterCard has said that there's been an increase of about 40% in contactless payments in Australia. Now, post-pandemic, the payment system board within the Reserve Bank is going to need to focus on a range of issues associated with non-cash payments. The main ones revolve around the networks used to process payments. Australia has three main networks: the Visa network, the MasterCard network, and the EFTPOS network. Now, all of these three networks for payments are privately owned and charge merchants for every dollar transacted on their network. While there's regulation in Australia that limits some of these network charges, this regulation has been a game of whack-a-mole for the last 15 years. The RBA fixes the rules, the private networks work out ways around the rules, the RBA changes the rules, and it keeps on going. Post-pandemic, we're going to have to face the issue that if cash becomes a residual or redundant payment instrument, can we continue to have a system where almost all our non-cash payments occur through private networks and where these network owners can largely set the terms and conditions for using those networks? Or do we need some alternative form of currency? Do we need an RBA-issued digital currency or some alternative payment network? If we do need a different system, what's the government's role in designing and facilitating that payments network? Now again, these aren't new questions, but the pandemic and the decline in cash payments has reduced the time available to answer them. Final thing I want to touch on relates to data in the pandemic. Now, in many countries, including Australia, location tracking has been used to limit the transmission of the coronavirus. In Australia and many Western countries, that's been done manually. That's in stark contrast, for example, to South Korea, where data from 28 organisations, including police, smartphone companies and credit card companies, is used to analyse the movements of infected individuals. This high data approach has been largely successful in limiting the spread of the virus, while limiting the impact on the domestic economy. Now, that's not the only example of technology. The use of, for example, wristband technology to ensure people aren't violating quarantine has been used in Hong Kong and has just been introduced in Singapore. However, when we come to Western countries, they seem to have been reluctant to adopt technological solutions to the pandemic. Now, in part, these appear to be driven by privacy concerns of individual citizens. While individuals appear happy to allow private companies such as Google, Apple and Facebook to have access to their data, including location data, these same citizens appear not to want governments to access the same or similar data, despite the potential health and economic gains. The discussion in the West has focused on privacy and data ownership. So, for example, in Europe, general data protection regulation is very much focused on consumers owning their data. I think that's wrong-headed, and fortunately, I think that Australia is heading in the right direction. Australia, through its consumer data right, has recognised that the data that is of so much value to Google, Facebook and so on is a jointly produced product. The raw information from the consumer, what they like to buy or where they've been, is of little value. It only becomes valuable when the consumer and the company put that data together with the data of millions of other consumers and create the value so that they can send me ads for products I didn't even know existed and I'd actually quite like to buy. Now, Australia's already gone down a consumer data right approach. It's being introduced in banking to reflect the fact that you have a joint product in data. However, the pandemic's made it clear that there's a third party to this equation, not just the consumer and business, but also government. In post-pandemic, we're going to need to have a discussion in Australia and most other Western countries about what the role of government is with regards to this data. When can the government require data, as it already does in many situations? When can it require location data or health data or other data about my movements so that it can create a public good which helps prevent the spread of a virus? So post-pandemic, we're going to need to have this conversation. Fortunately, in Australia, we're part of a way to a sensible solution through our consumer data right approach. But that model needs to be explicitly expanded to include government. In particular, what are the social rights to data that are invested in the Australian government? And how and when can the government use that data? These questions need to be addressed quickly, because whilst the current pandemic will be finished before the questions are answered, this will not be the last pandemic. So, thanks, Arthur.
Thank you very much, Stephen. We're going to move into our Q&A portion of the webinar now. And so we're going to open it up to all our speakers. I'd like to start off with just an open discussion, I think, about there's obviously winners and losers through the process of this pandemic. How do we see the impact of the pandemic on entrenching market power? And in particular, some of the major companies such as Google, Facebook, Amazon, and Apple that are in the news quite recently. I might start with Stephen. You have a rich background in antitrust regulation.
Yeah, okay, thanks. I don't think there has been a significant change in entrenching the market power of the big five, if you call them that, you know, the Facebook, Google, Amazon, Apple, and I'll remember the fifth one off the top of my head, or Simon will tell me in a second. What we've seen during the pandemic is some odd behaviour in the US, which tend to suggest that the current regime in the US is quite happy to intervene in very odd ways to deal with particular technology companies. We've seen Europe continuing on its push to essentially turn its antitrust laws into national champion laws in terms of digital technologies. I think the real issue that has been brought to fore, though, for those big tech companies in the pandemic has come back to this issue of data. And because I find it quite absurd that the data exists. It's in the hands of those private companies who gained it from individuals voluntarily. The data exists so that we could use proper track and trace technology to avoid things like the current Melbourne lockdown. And we don't do it. And in countries like Norway, for example, Norway had an app where, as it was being downloaded, it was appealed to the courts that it was a breach of Norwegian privacy laws, and the government actually had to delete all the data from that app. That strikes me as an absurd situation where we're saying privacy will trump any health benefits associated with that data. So I think that's the real question.
I'll open it up to our other speakers, but anybody else want to jump in?
Yeah, sure.
Well, go ahead, Simon.
I think, yeah, I think it really is all about the data. And I think this has really accelerated the value, recognizing the value of that data. And one of the things, if you look at cloud computing, the economies of scale don't seem to go away. So there's basically a global contest to get the world's data onto your platform between Amazon, AWS, Microsoft, and Google. And the door pretty much swings one way. Once the data is on a platform, it's extremely costly to get it off. And there isn't plug and play across platforms. So there's sort of a whole bunch of antitrust issues around that, around data portability, data sovereignty. And of course, then I can commercialize the data. And so, for example, everybody's trying to get healthcare data. Amazon's put the 10,000 genomes on AWS and made that available. If you're a medical researcher, you know, the more hospitals that put their data on AWS, the more valuable it is to be on AWS if you could have, you know, anonymized access to other people's data as well. So there's really going to be concentration there, and I think it's just going to become more entrenched. I think on the other hand, you're going to see at the periphery, because the role of sunk costs have fallen, unless you're one of these big data holders, you're going to see more competitive markets at the periphery and more traditional markets as everybody adopts the same technology in the brick and mortar world. That's all going to become more competitive and more brutal. And so you're going to see basically an increase in the concentration of rents across industry as the platforms become more and more valuable.
Were you about to jump in there as well?
Actually, Simon, I agree with Simon. That's what I was going to say, that it is very likely that barring some regulatory intervention, the big platform companies will continue to enhance their dominance. But the non-platform tech businesses, that's a different story altogether. And, you know, I mean, even with regulation and all the noises that I've been living away from this country for many years. When I left 25 years ago, there were 4 big banks. And there's been a lot of talk about, you know, this, that, and the other. We still have 4 big banks. So I'm very skeptical about the ability of governments to shape, you know, the direction of the tech industry. I could be surprised, but I think the big platform companies will just become more and more powerful.
All right, I want to get to some of our questions from our audience. So I've got one here from Greg Bamber. He's thanking all the excellent speakers. He wanted to talk about the implications for jobs and workers. And so Fraser and Simon both alluded to a need to rethinking the social contract between business and workers, prompted by digitalization as well as by the pandemic. Could one of the speakers or any of the speakers reflect any further on the notion of rethinking the social contract about work and employment in the Australian context? I might start with Fraser.
Thanks for the question, Greg. So I think what's interesting, if you look at the Australian economy at the moment, and we did a recent project where we benchmarked digital skills. And Australia comes out overall pretty well. But if you dig a little deeper, you start to see the gaps. And one of the biggest gaps, if you just look amongst the current digitally skilled workforce, is that most of those skills of Australian workers are what we call sort of the basic skills. So they can use basic digital products and services. But increasingly, the way that the market is shifting very rapidly is there's higher order skills needed around integration of different digital technologies to compute different end products, and also in some cases sort of more innovation-led at the pointy end of things. So there is a massive shift that needs to happen. And the research, which will be released in a month or two, basically shows the scale of that, which is basically the current digital skills would have to increase roughly about 6x in the space of just 5 years in the Australian economy from where we are today. So we're not talking about a shift around the edges. We're actually talking about a really massive revolution to get there. And that's point one. Point two is that when we look about the groups of workers, we think about them in 4 groups. And I think it is important to think about these groups because each of them have different policy interventions and needs. And so there's the currently digitally skilled workforce, which is about how to accelerate what they already have. There's a sizable group though in Australia, about 40% of workers that don't use any digital skills. And that's a different set of interventions that's going to be needed with them. Then there's a third group, which is obviously about the future workers, right? And so there's a question mark about how do we update curriculums fast enough to equip them with the right kind of skills that are going to be needed. And then finally, I guess what are called disenfranchised workers. So the unemployed, but also the ones that are not participating in the workforce. And here Australia actually has quite a sizable hidden gap that we don't talk about enough. And that's a very different set of policy interventions. But there are countries, including Korea and Singapore, that actually do some really interesting things that I think Australia can learn from. So I think that'll be, I think, part of the mix of what happened. And as I said earlier, I think government can't do it alone. I think businesses are going to have to step up a lot here. And I think the old model of basically hiring in new rather than retraining existing is going to have to shift. And it's going to have to shift in quite a significant way. Thank you.
Simon?
Yeah, just I think I'm in violent agreement with Fraser. I think he framed it exactly right. This isn't just about work and it isn't about reskilling. It's about thinking about those whole 4 segments that he was talking about. And in particular, those who've left the workforce are a really big chunk of the population and often ignored in these discussions, right? So we need to really think about this from a whole social contract point of view, looking at lifelong education, the fact that any skill you learn is going to become redundant at some point in time with high probability. And so you have to be able to intertemporary substitute, if you will, rather than just one and done, getting all your education when you're young and then, you know, hurled off the deep end of the pond. So we need to have sort of a lifelong model. We need to recognize that social engagement and social contribution is beyond just the workplace and how we get around people feeling disenfranchised there. It needs to be a serious discussion, like Fraser said, about all of these issues and looking at other models that have worked well in other countries. In some areas, Australia does particularly well, right? We have a fairly good safety net compared with the US where I came from. And we have a very high minimum wage compared with other countries. So both of these are part of the social contract, but there are other dimensions where I think we need to revisit it dramatically, in particular looking at it rather than cross-sectional, you know, over people's lifetime of society.
Okay, I might have a question here for Deeb about how the pandemic has had an impact on the funding of startups domestically in Australia, whether it's impacted the funding for those technologies, and if any, are there any parts of the technology startup sector that we've seen an improvement in their prospects for attracting funding?
Yes, the funding market has not been that great over the last couple of quarters. It's probably been about a 20-25% decline globally in the number of early stage ventures being funded. It seems to have stabilized of late, but that's sort of where things are. I think, you know, on average, about 500 fintech deals get done in a quarter, and the run rate now is about 400. A disproportionate share of the decline has actually come to this part of the world. So US and Europe doing relatively better. Within the sort of fintech area where the deals are still getting done is, you know, things where someone's doing something to enable e-commerce. That's sort of okay. Cyber insurance is an area where deals are getting done. Interestingly, if you've got a cool software that enables a bank to do better debt servicing, then those types of business, I mean, as you can imagine, given the environment we are headed in. and also anything related to real estate, which is not really fintech, but you know, the real estate industry doesn't use, especially on the selling side and so on, or you know, remote notarization and so forth. So the wealth tech, capital markets tech has taken a deep dive. Not much is getting done there. But I would also say that it has become a lot harder to get seed, early stage type funding. And if you're doing a Series D or you're pre-IPO, you're still okay. But the very early stages, or you know, scaling up from a prototype, or you know, you've got 2 customers and I want to scale up, that has definitely been impacted. But I don't think that is a permanent change. There's a lot of capital available. Just people are taking a step back, trying to figure out, you know, where to place the bets. And you know, I mean, it's election year in the US. Generally, venture funding tends to fall as people try to speculate on what sort of regime the next 4 years will bring. And you know, this year is no different.
Okay, I think we've got time for just one more question. So we've got one from Roham, who asked, due to the COVID-19 impact on supply chains, we are seeing a lot of delays and issues bringing in goods to the Australian market. How do we think it will, or how do you think it will take the invisible hand to fix the problem and find a new harmony, or do you believe it will be a new reality? So this is a question about supply chains and the difficulties with moving goods into the country in light of the pandemic. Does anybody want to start a comment on that? Stephen's got his hand up, I can see.
Just a reminder of where the word quarantine comes from, which is, as I understand, from Venice, when they worked out that keeping the ships offshore for 40 days was a good way to work out either everyone on the ship was dead from the plague at the end of the 40 days, or you could let them land. So is the invisible hand going to solve this? This is a matter of government regulation. The government decides how long ships have to remain off, what exact quarantine procedures are put in place. My fear in this space is that the government is probably overly conservative in Australia because, hey, goods and services getting in 2 or 3 days faster may create huge economic benefits, but the government doesn't get the credit for that. Ending up with COVID-19 getting back into or spreading further in any state, coming in from you know, ships or flight crew on aeroplanes, there's a government disaster. So it's a government problem.
Any other thoughts from the panel, if anybody would like? Fraser, I saw you unmute.
Yeah, look, I partly agree with Stephen. I do think that things are starting to change pretty quickly as a result. And at the most basic level, we've seen e-commerce companies just reshift their settings. So Redmart here in Singapore, which is a big online grocery provider, they had people that were ordering 800 bottles of water and truckloads of noodles for a small household at the start of the pandemic. And then they started putting in restrictions and better things that actually adapted. So we've seen that basic stuff happen. We're also starting to see some real innovations happening in supply chain technology to build better resilience and monitoring of supply chain channels. And this is less of an issue maybe in Australia, but in particularly in other parts of Asia, most of the key markets have traditional distribution channels. And so there's a huge amount of food loss, huge amount of out of stock rates that just happen naturally. And so using things like Internet of Things technology gives much better control over that supply chain that we've had in the past. So I do agree that it's going to require a government shift in this, and there's a lot of big pushes to greater food security. You know, here in Singapore, there's a 30 by 30 strategy, so 30% of food supply domestically by 2030, which is kind of extraordinary given the size of Singapore. So we are seeing that shift, but I do also think this epidemic will actually prompt a real transition in terms of the speed of application of some of those relevant technologies.
Would anybody else want to touch on that question? No? I believe we are out of time. And so I'd like to take this opportunity to thank all our speakers and all the people online that have been sending in questions. Unfortunately, we don't have enough time to obviously touch on all of them. I'd like to thank you all for your participation and for everybody listening to us online and watching.